Imagine this: your mortgage rate, your car loan, even your landlord's next rent hike. They're all decided by an invisible force. A market so massive it dwarfs every stock exchange on Earth, yet most people have never even looked at it. This isn't just about some boring investment, it's about the hidden engine that prices your entire financial existence. If you've ever wondered why borrowing money got brutally expensive overnight, or why safe investments suddenly weren't, then you need to understand bonds. And by the end of this video, you will. Most people think the stock market is the center of the universe, but the bond market is the sun that the stocks revolve around. It is a $145 trillion machine that dictates the cost of living for every human on the planet. Whether you are trying to buy a home in 2026 or just trying to keep your retirement fund from evaporating, you are playing a game where the rules are written in the bond market. If you don't get how this works, you are essentially flying blind in your own financial life. While the S&P 500 gets all the headlines and the flashy graphics on CNBC, the bond market is the one actually holding the steering wheel of the global economy. It is the ultimate arbiter of value, deciding what a dollar is worth today versus what it will be worth in 10 years. If the stock market is the ego of the financial world, the bond market is its cold, calculating superego. Let's strip away the jargon. A bond is just a fancy IOU. When a government needs to build a bridge or a company like Apple wants to expand, they don't just check their savings account. They borrow from you. You give them $1,000, and they promise two things: a fixed interest payment called a coupon, and your original money back at a later date. It sounds simple, almost boring, until you realize that this simple contract is the foundation of global stability. When the US government runs a deficit, which it does constantly, it sells treasuries. When a startup with shaky math borrows money, those are high-yield bonds, or what Wall Street used to honestly call junk bonds. The critical thing to understand is the inverse relationship between price and yield. Think of it like a seesaw. When interest rates in the economy go up, the value of existing bonds goes down. Why? Because if you hold a bond paying 2% and the government starts issuing new ones at 5%, nobody wants your old, low-paying bond at full price. You have to sell it at a discount. This single mechanic is responsible for more financial carnage than almost any other force in history. In early 2026, we saw this play out as the Federal Reserve maintained a cautious stance on rate hikes due to persistent inflation. When Jerome Powell speaks, bond traders don't listen to his words. They listen to the math. If the market senses that rates will stay higher for longer, the value of every existing bond on the planet takes a hit. It's a brutal mathematical reality that ignores your feelings or your portfolio's performance. If you want to know why your life feels more expensive today, look at the 10-year U.S. Treasury yield, 15%, and it is the most important metric in the world. Banks don't just pull mortgage rates out of thin air. To make it worth their while, they add a couple of percentage points for risk, and that is how you end up with a mortgage rate over 6%. This isn't just about houses. Car loans, credit cards, and the interest your city pays to build schools are all tethered to this yield. When the bond market moves, the cost of everything moves with it. Furthermore, the bond market is the world's most accurate crystal ball. When short-term bonds start paying more than long-term ones, a phenomenon called an inverted yield curve, it's a signal that investors are terrified of the near future. This signal has predicted nearly every recession for the last 70 years. While stock investors are busy arguing about social media trends, bond investors are looking at the cold, hard math of survival. In 2026, the yield curve remains a primary focus for analysts at firms like JP Morgan, who watch these spreads to predict the next credit cycle. If the 10-year yield spikes, it's not just a number on a screen. It's a signal that the cost of doing business just went up for every company from your local bakery to Amazon. For decades, every financial advisor preached the same gospel. Stocks are for growth, and bonds are your safety net. The classic 60-40 portfolio was the gold standard for retirement, but that safety net has recently turned into a snare. We saw long-term treasuries, the supposedly safest assets on Earth, lose nearly 40% of their value in a single year during the recent inflation spike. To put that in perspective, that was the worst performance for bonds since 1754. We are talking about a time before the United States was even a country. This volatility broke banks and forced entire nations to rethink their debt. As we move through 2026, asset managers like BlackRock are emphasizing that bonds must now act as anchors rather than just passive safety nets. The reality is that if you bought a 10-year bond when rates were at 1% and rates moved to 4%, you didn't just lose a little bit of interest, you lost a massive chunk of your principal value if you had to sell. This is the duration risk that wiped out billions in retirement savings. It's a reminder that in finance, there is no such thing as a truly risk-free asset. Even the backing of the US government can't protect you from the simple math of rising interest rates. If you think you are safe just because you don't trade stocks, you are missing the point. Your pension, your insurance company, and your bank are all built on a foundation of bonds. If that foundation shifts, the whole house shakes. There is a group of investors known as the bond vigilantes, and they are the most powerful people you have never heard of. Unlike stock investors who might sell a company because they don't like the new CEO, bond investors can crash an entire country's currency just by refusing to buy its debt. We saw this play out in a spectacular fashion when a world leader attempted to pass a massive tax-cutting budget without explaining how to pay for it. The bond market didn't just disagree, it revolted. Yields spiked so fast that pension funds nearly collapsed, and that leader was out of a job in just 45 days. This is the intimidation factor that makes the bond market the ultimate check on government power. In 2026, as global debt levels reach new heights, these vigilantes are more active than ever. They are watching every move by the Federal Reserve and the European Central Bank. If a government spends too much, the bond market raises the cost of that debt until the country is forced to stop. This is why your taxes, your public services, and the stability of your local currency are all at the mercy of bond traders in New York, London, and Tokyo. They don't care about political promises. They only care about getting their money back with interest. When you realize that the bond market can effectively fire a prime minister or a president, you start to understand why it is the true seat of global power. It is a silent, mathematical democracy where every dollar is a vote, and right now, the market is voting for extreme caution. If you are ignoring these signals, you are ignoring the most honest data point in the financial world. The stock market can stay irrational for years, fueled by hype and memes, but the bond market eventually demands reality. It is the cold bucket of water that wakes up the economy, and in 2026, that water is feeling very chilly for anyone carrying too much debt. They are the ultimate disciplinarians of the financial world, ensuring that no matter how much a politician wants to spend, the math must eventually work out, or the system will simply stop lending them the fuel to keep going. Understanding the bond market is like learning to read the weather patterns of the financial world. You don't need to be a professional trader to benefit from this knowledge. You just need to know which way the wind is blowing. When you see yields rising, you know that borrowing for a new home or a car is about to get more expensive, allowing you to time your big life decisions better. You also learn that safe isn't a permanent state. In this new era of 2026, where the Federal Reserve keeps rates elevated to manage persistent inflation concerns, the old rules of thumb are dead. You have to look at the duration of your investments and understand that a bond fund can lose value just as fast as a tech stock if rates move the wrong way. But there is an upside. For the first time in nearly 2 decades, you can actually earn a meaningful return on safe money. With investment-grade corporate bonds yielding over 5%, the bond market is finally offering a real alternative to the volatility of the S&P 500. The key is to stop viewing bonds as a boring background asset and start seeing them as the primary driver of your net worth. Whether it is through sustainable green bonds or classic treasuries, this market is where the smart money hides when the storm clouds gather. By paying attention to the 10-year yield and the shape of the curve, you are giving yourself a massive advantage over the average investor who is just chasing the latest trend. You are learning to speak the language of the people who actually run the world. The bond market isn't just a collection of numbers, it's the heartbeat of the global economy. It tells you when to borrow, when to save, and when to run for cover. Once you see the invisible strings it pulls, you'll never look at a bank statement the same way again. If this breakdown helped you see the bigger picture of how money actually moves, make sure to subscribe and leave a comment below. The bond